All right, well, thank you all for having me here today. I did a similar presentation for the CFA Society of Cleveland on Wednesday. I think everybody enjoyed it. It's a little bit of a different approach than what a lot of you have learned. I sat in dinner last night, and I was actually surprised in hearing Bill Miller refer, consistently to behavioral anomalies. So I feel like some of what I'm going to present today has already been presented for me last night, but that's great because he's a great advocate for the science. But I also heard people, one after another, say, as CFAs, we know that the only way to analyze a security and its potential value is to identify the future cash flows and discount them back to a present value, which is true. That's how you determine the fundamental value of a security. But who out there believes that fundamental value drives stock prices? Show of hands. Come on, fundamental values drive stock prices. Anybody? All right, so the question here is what time period? And that's a fantastic question because I believe that long-term stock prices should reflect fundamentals. So as we know more and more about a business, we can more fairly value it. But short-term, it's not fundamentals that drive stock prices. Short-term, it's sentiment. It's human behavior. So when you get a big earnings number, a surprise, and the stock price jumps 15%, you mean to tell me that the fundamental value of that stock changed 15% with that single release? No. That fundamental change has been building up in the company. We weren't aware of it. We didn't know how to value it. Maybe some people did, but the vast majority of the market didn't. And so once we had the information, we were able to value it. Similarly, a big miss. Stock price drops 20%. Is a company, the asset, really worth 20% less today than it was yesterday? Apply the same thing to the stock market. When the stock market drops 3% in a day on news, did the fundamental value of the aggregate underlying asset decline by 3%? No, it's perception. So that's what we kind of base our work around. We actually implement this in a number of portfolios where we're focusing on inefficiencies caused by not only market behavior, but also management behavior. Because remember, managements are the stewards of our capital. And we have to understand how they're incented and what their propensities are therefore, because incentives drive behavior. So what I'm going to do here is, and I could go through the very academic, what is behavioral finance and all that, but I'm not going to. The first thing I want to do is show you kind of what it looks like in the market. And the second thing we'll do then is kind of go through some of the behavioral tendencies that have been identified that we try to exploit, which is what the agenda tells you. So the common pitfalls of emotion-driven investing. So we all know that the way you make money in this business is to buy low and sell high, right? And yet, if you use aggregate mutual fund and ETF flows as an indicator of when people buy and sell left to their own devices, which is what we have in the gray bars, and you overlay it on this green line, which is the S&P, when do people buy? People buy high, and they sell low. So left to their own devices, people are actually doing the reverse of how you make money. Look here, peak inflows of all time were in the fourth quarter of '99, first quarter of 2000, so the very top of the market. People were chasing what had happened, which is a trailing 12-month return of about 18%. But what they got instead was a forward 12-month return of negative 22% and a forward 36-month return of negative 16% per annum. At the very bottom of the market, they were selling in what was at the time record numbers because they were trying to avoid what they had already experienced. You can't avoid what you've already experienced, but they were trying to. And so they were trying to avoid that negative 21% return. Instead, what they avoided was the forward 12-month return of 24% and forward 36-month return of almost 17% annualized. Peak outflows of all time came in the first quarter of 2009. So after the market had stopped going down, of course, we didn't know it had stopped. We could have looked and said the underlying asset probably didn't devalue by 50%. But instead what we said is an emotional response. And that emotional response is, I've lost all I can lose. I can't lose anymore. What I have left I can live with, but if I have anything less, I'm going to have to work until I'm 90, and there's no way I can take it, so I'm going to sell. And people did sell. They sold hand over fist at the very bottom of the market. But look what's happened now. We've had two 50% drawdowns in the market for very different reasons. Overinflated assets in the tech and media space, and the global financial system meltdown. But they're both in the last 10 years or so. And they're both fresh in people's minds. So what's happened now over the last 5 years? Have people gotten back into the market? And the answer is no. They haven't. Why? Well, because they're scared of these big drawdowns. They're not focused on the underlying value of the security. They're focused on the market price and the risk that they lose more money. Interestingly, we saw a lot made last year of the fact that for the first time in 5 years, we had net inflows into equity mutual funds. And that within equity, and for the first time ever, we saw, or the first time in the last 5 years, we saw slight outflows from bond funds. But let's put that in perspective, right? That was unusual because we saw inflows, not because of the scale of those inflows, because those inflows have come nowhere near the aggregate inflow we saw from 1990 through 2000, nowhere near the inflows we saw in 2002. But it's a change. It's a paradigm change. People are again focused on equities. Last night in presenting, I think it was Bill Miller who said that in January we saw the biggest outflow of all time for a single month from equities. Interestingly, the outflow was predominantly from ETFs. And active management actually continued to see an inflow. But there was this huge drawdown in the market. Why? Well, for the same reason that in August of 2011, when what looks like over the long-term scale to be a relative blip occurred, that was a 22% drawdown in just a month as you had the debt ceiling debacle. You know, people again sold the market because this drawdown and that drawdown were fresh in their mind. The volatility we had in January shook a lot of people out. So we've had this kind of persistent seller of the market, which is why I'm sure a lot of you sit in the office with your clients and your clients say, hey, you know, the market was up 35% last year. How come I'm only up 12%? And the honest answer is, well, because we diversify your portfolio, because we're looking to give you a more persistent pattern of returns over time, because we are building a portfolio that can weather all environments. So you were only a third in equities, and that third in equities was up 35%. The rest of your portfolio was effectively flat for the year. But people aren't happy with that. They want that full experience in the market. So we fully expect that with the market having done this, up 170% since the bottom in 09, there will be kind of building interest in the stock market on the notion that, oh, wait a second, I might have missed it, maybe I should get some. And invariably what's going to happen is that those flows are going to peak when the market's up here. We're not going to see inflows peak at the bottom. So people left to their own devices do buy and sell beta badly. And what does that lead to? This is a DOW Bar study, and it is dated December 31st of 2012. They haven't yet updated it for 2013, but it won't change. They update it every year, and it looks just the same. What this does is shows that if you owned the S&P 500, let's put aside the average excess return of a top quartile manager, but if you just owned the market, bought it and held it for the last 10 years, you would have had a return of 8.8%. But using that flow information, we know that the average investor in the market only got that return. And that's because we all know you don't make money buying high and selling low, and yet that's what flows show us people do time and time again. Now, we don't only time beta badly. This looks at the top quartile, or the return of a top quartile manager over the last 3 years. Every single quarter we move the data forward, and every single quarter we're taking a new top quartile manager. So it's not identifying a top quartile manager at the beginning of the period and riding with them. So there is an assumption that you're lucky or smart enough to identify a top quartile manager and ride with them for the whole period. But what you can see is that the excess return of the average top quartile manager is also volatile. It's very cyclical. When were people buying active management hand over fist? Well, back in here, because there were a couple of large cap growth funds that if the market was up 50% or 45%, were up 2 or 3 times that. And what have people done over this time period, the last 5 years? It's a big shift, right? We've seen people move away from active management, preferring ETFs. Why? Well, because active management hasn't worked. But again, people were buying active management hand over fist up here, and they're selling it down here. Similarly, if we're starting a search for a client, what do we start with? I need a new large cap growth manager. Can you help me find one? And so what we do is we sort the universe based on performance. We look at the managers that have outperformed versus the managers that have underperformed. We isolate those that have outperformed. We ask ourselves, how did they do it? How much risk did they assume? So what was the tracking error? What was the implied information ratio from that? Is it the same people doing the same thing the same way? And assuming that we kind of ticked all those boxes, we buy these guys, the guys that have worked. When do we sell a manager? We're professionals now. When do we sell a manager? We sell a manager when they've underperformed, because it's an indication that maybe something's broken. So not only do people buy and sell beta badly, but left to our own devices, we buy and sell alpha badly. A lot of people have asked, why is that? Well, it has a lot to do with time horizon. If you think about the time horizon of the average investor, let's just, to put it in perspective for a second, a 65-year-old investor used to be a short-term investor. They had to, reallocate their portfolio into safer assets, preferably something that generated some kind of income, because they were no longer drawing a paycheck. They needed income to replace that. And that was because when Social Security was instituted with an age of 65, the average life expectancy was 68. But today, if a couple lives to be 65, there's a 50% chance that one of them lives to be 90. So even at 65, you're not really a short-term investor. And interestingly, and I did hear this echoed several times last night, conventional wisdom says that when you get to that age, you're supposed to take your equity money and move down the risk spectrum into fixed income. But if the 10-year yield's 260, that's not a winning proposition because, I don't know a lot, but I do know that there's not a lot lower the 10-year can go, and it's at a historic low level, with the exception of the last 18 months or so when it has been marginally lower. So over time, we expect the 10-year is going to appreciate. So what have people done? People that are approaching retirement, they go with the conventional wisdom. And the conventional wisdom is, I should take less risk. And it feels like the right thing to do despite the fact that 10 years at 260 because we talked before about that recency effect. So what's happened recently kind of driving your future or your behavior relative to the future? We're doing that because if you look at small caps, large caps, corporate bonds, govies, and T-bills. And what we've done is looked at returns going back to 1950. And so the first one-year return is January of 1951. The second one-year return is February of 1951. So we've just rolled it forward monthly and identified then what is the best and worst period for each of those asset classes. Well, the reason people are hiding in the least risky assets is because they have the least potential downside. They're not using the perspective of what's my actual investment horizon. Because if they looked at what their actual investment horizon is, they'd be able to focus much more on the fact that the riskiest assets have the greatest potential upside. But that's not what we're doing right now. We're hiding out. We're trying to preserve capital as opposed to grow capital. But now let's extend the time horizon. So what I'm going to do is I'm going to show a sequence of bars, and they show a 3-year, a 5-year, 10, 20, 30-year. And what you see is that as you go out a little bit, well, those tails get pulled in. So suddenly, the small caps still have the most upside. They still have the most downside, but instead of down 45% a year, they're down in 1 year. They're down 21% for 3 years straight, which mathematically is actually worse than the 1-year experience, but the tails are clipped. Now, as you keep going out to 10 years, what do you notice? You notice that the top is kind of preserved, so the number comes down marginally, but that bottom, or the downside, comes up dramatically. So let's go back to what I said before. If a couple lives to be 65, there's a 50% chance that one of them will live to be 90. So if there's a 50% chance that somebody's going to live to be 90, and they're investing their assets when they're 40 or they're 50, what's really their time horizon? They're long-term investors, which is why if we look at 10 years, 20 years, even 30 years, it's not inappropriate. It's absolutely appropriate to invest with that kind of time horizon for most investors. And maybe not all of their assets. Sure, somebody who's 65, you need to start to de-risk a little bit, but they still have to have a growth asset in that portfolio because they need 25 years of income off of a given asset. So it's hard to see because of the scale over there. So what I've done on the next slide is shown you just the 1 year and the 30 year, but change the scales on the two. So right now, we know that what people are doing is investing as if they're short-term investors, as if they need their money this week, this month, this quarter. They're investing in this stuff, which is the least risky. But they're not short-term investors, they're long-term investors. So if we look at the right-hand side, we're now looking at 30-year rolling returns. And what I would draw your attention to is the fact that if you had picked the single worst month since 1950 to make an investment in the riskiest asset class up here, so small caps, had you bought and held, the experience would have been positive 9% per annum. Had you picked the worst month and done nothing other than bought and held. Had you picked the best month, if you're fortunate enough to do that, you get 20% per annum over the next 30 years. But let's focus on the worst period for the riskiest assets. And now let's slide over here and look at the riskless assets. Had you picked the best month, going back to 1950, to buy a riskless asset, your best 30-year return is positive 6%. So there is a almost 300 basis point gap between the two. The reality is, unless we get really lucky, nobody's ever going to pick the worst month or the best month. You're going to get somewhere in the middle. But somewhere in the middle here is a lot better than somewhere in the middle here if you're truly a long-term investor. So one of the conversations we have to have with our clients and with our board members and with our trustees is, we need to keep it all in perspective. What's the appropriate time horizon? Remember, we're investing to that time horizon. Risk assets are one piece of what you're doing. It's not the entirety of what you do. We build a diversified portfolio to give you a smoother return, but you can't avoid these. And yet people do time and time again because of recency, because they're focused on what happened last year, the year before, in the last 5 years, and not focused on what their needs are and the likely long-term outcome. So people say today, isn't the market expensive? And I heard everybody address it on the panel last night at dinner, and they kind of all came to the agreement, well, not all of them. I don't think Jim Grant agreed with them. But Shad and Bill certainly agreed that the market is, by historic standards, kind of fair valued to maybe a little bit overvalued, but it's not extremely overvalued. Again, if you focus on the underlying asset price, in 2000, when the market was at about this level, the underlying earnings power of that asset was $55. In 2007, when the market was at about this level, the underlying asset value, or the underlying earnings power of the asset, was about $85. This year, so we're a little bit higher, marginally higher. But this year we expect earnings to be $120. So you're basically paying the same price today for what you paid for half the underlying earnings power 10 years ago. So is the market expensive? We don't think so. Is it at an all-time high? Yes. Is the value of the market, though, that 1830 or wherever we are today, just a number? It is, but people get focused on the pattern, which shows the market goes up, the market goes down 50%. The market goes up, the market goes down 50%. Well, guess what? The market's up again, and anybody who has a 3-year-old knows about patterns, right? So if you see this enough, then when it gets up here, it must be time for it to turn around, but we don't think it is. So there's really 2 components, or 3 components to asset appreciation: capital, underlying earnings, dividends, and then multiple expansion or contraction. So you can identify what's the earnings power. You can identify what are the dividends likely to be, but what's not as obvious is what should the multiple be. Today that multiple is just a little bit ahead of the long-term average, but interestingly, we also know that the multiple of the market has a very high correlation with consumer sentiment. So as consumer sentiment gets better, multiples expand. As consumer sentiment gets worse, multiples contract. When were multiples the highest they've ever been? Looks like January of 2000. When things felt really good, multiples were as big as they've been. When were they as tight as were multiples as tight as they've ever been? Well, it's kind of November 08, August of 2011. But what you'll notice from this is that people don't spend a lot of time feeling, mediocre. They either feel really bad or really good. And so you notice that as this line starts to go up, it tends to continue going up, and as it starts to come down, it tends to continue coming down. So what we see now is a market that's on an upswing from a sentiment perspective. It's on an upswing from a valuation perspective, but things don't usually end at fairly valued. They usually end up at overvalued. And to take that one step further, let's look at the things that drive sentiment. So what would a 10% year-over-year rise in gas prices do to sentiment? Well, it would detract from it because you're paying more for your energy costs. What would a 10% year-over-year rise in home prices do? Well, it improves sentiment because suddenly your biggest store of wealth is worth more. A 10% year-over-year rise in the S&P, again, improves sentiment because after your home, typically an equity portfolio is the biggest store of wealth. And a 1% year-over-year rise in the unemployment rate, of course, hurts. But now, which direction are each of those going? A 10% year-over-year rise in gas prices hurts, but we're actually going the other direction. Gas is trending down. A 10% year-over-year rise in home prices helps, and home prices are rising. A 10% year-over-year rise in the S&P helps, and the market has continued to go up. And a 1% year-over-year rise in the unemployment rate hurts, but of course we're going in the other direction. So all of the things that are the biggest contributors to sentiment are going up, are getting better, which indicates that sentiment should continue to get better, which to us means that for that reason alone, not because the underlying value of the asset has changed, but for that reason alone, the market can go higher as sentiment improves and multiples continue to expand. So if that's what it looks like, well, what is behavioral finance actually? Or how do you define the study? Well, the theory is that behavioral finance is how psychology impacts the financial decision-making process. So how does what's going on inside your head derail your ability to do what you might know is right? I mean, we're all logical people, right? But we're also first and foremost emotional people. We think that by better understanding behavior, it's possible to identify and exploit those anomalies. And that's what we look to do constantly from an investment perspective. But why is that possible? Well, that's possible because of our brains. When we were all cavemen, and there was a saber-toothed tiger walking very slowly across the plains, and we saw him coming, we didn't stop and analyze how fast is he, how fast am I, is he hungry, is he not, when was the last time he ate, should I really turn and run, or should I just kind of stick it out and he'll walk on by? What did we do? Climbed a tree, ran like hell, I don't know, something to get out of the way of the tiger that was coming, and that was this part of our brain telling us that's what we should do. It wasn't this part of the brain. That always kicks in second. It's not unusual from an investment perspective. I mean, I think we all, as we buy things, look at, after we buy them, the alternatives. So the other things we are considering, if we're looking at a name in a sector and we think it's going to be the best performing name in a sector, well, how did everything else do? Similarly, when we sell, we always look back and say, how has that done since I sold it, and was that the right thing to do? And that's the logical part of our brains kicking in. The emotional part of our brain is what leads us to action, and it's the first and strongest reaction. Of course, Daniel Kahneman, who is covered in the CFA materials, was the first non-economics major to win a Nobel Prize in economics in 2002, studying exactly this. How do we make decisions? Why do we make decisions? How do we confer the benefit of a gain versus feel the pain of a loss? And the reality is, we feel the pain of a loss much more. So if I give you two probability-weighted identical outcomes, but one includes the possibility of you're losing money, you'll avoid the one where you could potentially lose money and opt for the other one. And it's just the way we work. Even if probability-weighted, you have exactly the same outcome. So we feel the pain of loss. Warren Buffett said, the way you make money in the market is to be fearful when others are greedy and greedy when others are fearful, which means buy when others are selling and sell when others are buying, which if you look back at that very first chart, it's probably the right thing to do. Because people buy tops and sell bottoms, so we should do exactly the opposite, right? But this relationship here, this could be anything. This could be the asset value of a company. This could be the market. This could be active management relative to long-term expectations. But in each case, as fundamentals are getting better and better and better, we're able to justify a price paid, and we tend to buy companies, markets, management teams at peaks and sell them at the bottom. Why is that? Well, there's a bunch of reasons for it. And it's these, the common pitfalls that you've probably read about. It's overconfidence, anchoring, representativeness, confirmation bias, ADD bias, which hasn't been studied, but we all know it exists, right? That's the fact that 15 years ago, our clients got a quarterly statement. And it probably came a month after the quarter end. And it was a paper statement. And, they looked at it, but it wasn't really reflective of what's going on now. In fact, back in the day of a paper statement, so let's go back to 1987. You had Black Friday in October of 1987. If you didn't get a statement until December, you wouldn't have seen Black Friday. Black Friday is something that happened and then corrected itself so quickly that by the end of the quarter, the market was flat. And yet today, what do? We don't give people a quarterly statement. We give them a quarterly statement, but we also give them online access to their portfolios. And there's been this huge migration from investing in mutual funds to investing in separate accounts. And of course, the NAV on a mutual fund might go up and down a nickel. The NAV on the underlying security values go up and down a lot. So how many times have you had a client who, if they looked at that bottom right corner of their statement, would say, everything's okay, but they're not looking at the bottom right corner of the statement. They're going, what the hell? We owned Apple from 700 down to 400? And they're now questioning you about, what they should be focused on is that bottom number. But that's this, right? That's the fact that they have online access to their portfolio, and they're tracking it every single day. And every time a stock gyrates, they either get euphoric or despondent, and they invest according to that. And then, of course, herd mentality. And we'll go through each of these in a little more detail. Overconfidence is exactly what it sounds like. It's overestimating or exaggerating one's ability to successfully perform a particular task. Now, how many of you would want to hire a lawyer to represent you in a case if he said, chances are pretty good we lose? None of us, right? Well, not surprising then that 68% of lawyers in civil cases think they're going to win. But mathematically, only half of them can win. 80% of students, apropos, because we're at SMU today, 80% of students think they'll finish in the top half of their class. I don't know about you, but only half of them can. 81% of new business owners thinks their business has a 70% chance of success, but only 40% think that their competitors have a chance of success. It's that notion of overconfidence. And it exists not only in those instances, but down at the bottom here. It exists in analysts as well. We had a little bit of fun with the sell side last night. But the reality is, that analysts have big egos. Analysts are published. Analysts show up on CNBC. Analysts get included in the institutional investor polls. Analysts' names are published all over the place. And they're prideful people, just like we all are. So in the beginning of the year, they have an outlying view on a company. And it doesn't start to pan out. Well, you know what? I did my work. I know it's going to work out. I'm not going to change it based on what's coming up, because I really think that by year end, and we can talk about whether or not a 1 year period is the right period or not. A calendar year is kind of an arbitrary period, but they believe that by the end of the year, their thesis will prove out. But when it gets to the late third, early fourth quarter, and they start scratching their head and going, okay, so what would they actually have to do to make it where I am? They're more concerned about being right at the end of the year and printing the right number at the end of the year than maybe sticking with their convictions. So you don't see a lot of analyst revisions, or you don't see revisions of the same magnitude in the first 3 quarters as you do in the fourth quarter, because they're playing catch up. They're looking to get it right at year end, which is the number that they print. Anchoring. So it's an old example. Obviously, Apple is neither at 10 nor at 70. But it's representative of what anchoring actually is. And what I would draw your eyes to is this down here. So and a corresponding slide up top. Apple trading at $10 because analyst estimates for the quarter were, what it looks like, between 4 and 4.2 cents. But what actually happened? Apple beat. And in the next quarter, consensus was this red bar, Apple beat. For 9 consecutive quarters, consensus got it wrong. Why? Well, the speaker before me was asked about Bitcoin, and he said, I don't understand Bitcoin. And I don't understand Bitcoin either, so that's no poke at the last guy. But it's a reality. And when you don't know something or don't quite understand it and can't get your head around how's it going to work, how can you value it? Well, that's what Apple was doing. Apple was Bitcoin back in 2003. Because for all of us who grew up with a phonograph and went from a phonograph to a cassette player, and from a cassette player to a Walkman, and a Walkman where you had, you could play your 12 songs in sequence, and halfway through you had to flip the tape over and put it back in, to a CD player where you had those same 12 songs, but you could play them in any order, to an iPod. You remember trying to wrap your head around that for the first time? You're trying to wrap your head around, how can I get all of the music that's in every one of those CDs, cassettes, albums, into this little thing the size of a deck of cards, and at will jump from one song to the next? Nobody could understand it because they were revolutionizing. And so that's reflected in this. Well, as you get out to here, people started to understand the iPod. But I can remember the first ad that I saw for the iPhone. And it was a silhouette of a guy walking down kind of an urban environment, and it was his shadow, and he's listening to music, so he's kind of dancing, and his phone rings. And the music stops, and he picks up his phone, and he talks to whoever's calling. And I can remember trying to get my head around a phone and a music player? Well, it's evolved to so much more today, and we kind of all take it for granted because we understand the technology today. But during those periods, people are anchored on what they know. In the case of Apple, they're anchored on CD players. They're anchored on Walkman. They can't possibly judge what's coming. And that anchoring, by the way, also takes place in stock prices. So in our personal account, we've done all this work, and it's a stock that for whatever reason we can't own in our portfolio. Maybe we're a large cap manager, it's a small cap stock. But I've done my work. I'm buying the stock at 20, and I am dead certain it's worth 30. And the stock goes up to 24, and I've got a 20% gain, which I might be happy with and just sell it and move on to something else. But I'm certain it's worth 30. And the stock backs off to 22. What do? Well, have fundamentals changed, or is it sentiment? I don't know. But the stock that was worth 24 that I thought was worth 30 is now worth 22. And if it's not worth 30, it's at least worth 24 because that's where it was yesterday. And it backs off again to 20. Now we're break even. We could cut bait and head on off into the sunset and be perfectly fine. Didn't win, didn't lose, but that's okay. Breaking even is actually a win in relative terms. But we don't because, hey, wait a second. That was worth 22 yesterday and 24 the day before. So it's not really worth where it is. I'm going to hold on to it. Chances are if we go through that little cycle, we're going to sell it at a loss. Because if it recovers and goes to 30, suddenly in our minds, well, if it made it to 30, it's probably worth more, so why would I sell it here? Which is why when we talk through at the end some of the tools to use to overcome the urge to make bad decisions, one of the things we have there is write down your rules, know your rules. Because if you know what something's worth, you have to invest according to that. Now, if that stock had backed off to 18, suddenly we're not focused on the 30 we thought it was worth. We're focused on the $20 we had invested and how do we not lose all of our money. And we don't lose all of our money by selling it before it goes down anymore. Chances are pretty good that if we're that person that looks in the rearview mirror after we make an investment decision, we look back 6 weeks later and it's worth 28 or something like that. But despite that, we invest emotionally, and anchoring is one of the things we look to exploit. Representativeness, another old example, but Macy's had gone through a whole series of acquisitions. Now, they didn't, through their entire history of existence, go through a whole lot of acquisitions, but during a period in the early 2000s, they went through a whole series of acquisitions. And so you look at them, and they look really expensive, because earnings have been depressed. But if you look at them on a trailing basis, or look at cash flows, they actually didn't look really expensive. But they had gone through this period of, kind of a hyper acquisition. And we looked at it and said, well, from a valuation perspective, that's not the kind of thing, from a forward-looking valuation perspective, the kind of thing we want to invest in. But of course, had you sat down and talked to management, what management would have said is, yeah, we did all that, and we're done. Now we're going to try and digest that. So, you're looking at what looked like it wasn't a good company, but in fact it was. But a good company is not always a good stock. Macy's had one of these. As people were trying to figure out what are they actually accomplishing. They are so expensive. Why are they so expensive? Are they going to continue to spend my money hand over fist, or are they going to take a more rational approach to managing the business going forward? And they took a more rational approach to the business going forward, and a lot of people who didn't own it because of this also didn't benefit from that on the backside. But it's because you're looking at what's recently happened, or a small set of data, and using that to forecast what the future is going to look like. Confirmation bias. So one of the greatest creations of the last 20 years is Microsoft Outlook. And we can all agree or we can disagree, but suddenly I have a way of communicating my availability through my calendar to anybody else who's on Microsoft Outlook. So we want to set up a meeting. I say, my calendar's current, take a look at it. You can take a look at it and say, all right, I'm going to put it in on this slot. And we've just scheduled a meeting without having to talk or anything else. My calendar at JP Morgan is absolutely useless. Why is my calendar useless? Well, because in the equity group, every single one of us gets an email and a calendar invite anytime any one of us sets up a meeting with a company management team. And we probably meet with a dozen company management teams a day. And unless you actively go in and decline a meeting so it doesn't show up on your calendar, and by the way, when you decline the meeting, you say don't send a response because you don't want to kind of put it in somebody's face that you're declining their meeting. If you don't decline it, it shows up on your calendar by default. So then when you want to set up the meeting, I say my calendar's current. You go, well, you've got 14 minutes between 4:46 and 5 o'clock, and we need a half hour. So my calendar is completely useless. Now, when I select then, who am I going to go and listen to? Who do I want to talk to? Which of these company managements do I want to listen to? And sometimes it's strategists, market strategists. Who do I go listen to? I go listen to the guys that sound like me. Because it's easy. I have a belief. This guy's smart. If he believes what I believe, then I must be right. It's easy to do. Confirmation bias. It's easier to listen to people who sound like you than people who sound different, who don't sound like you. But the best thing we can do is listen to people that don't sound like us. Why? Well, because if I'm building a thesis for something, anything really, and the only people whose advice I seek out are people who believe along the lines of what I believe, I'm just going to create a stronger and stronger reason why my thesis is right. But by listening to conflicting views, you actually are able to build a more robust view. And look, maybe your end view is the same, but at least you understand what some of the identified risks are. Maybe, just maybe, through the course of doing that, you think, that actually makes a lot of sense. And maybe you change your mind. But it's very hard to do. So what we constantly encourage people to do is to look and thoroughly consider disconfirming evidence. Because no one of us is going to be right all the time. We'd all like to be right all the time, but we're not going to be right all the time. So hearing people who sound differently from you helps you build a more realistic long-term thesis. We talked about ADD bias, right? But it's not just our clients focused on their account statement or looking online at their account holdings and calling us up and asking in early January, why do we own Best Buy? Okay, well, like really, it's one of 400 different holdings, and your bottom line actually went up despite the fact the stock went down. So what are you worried about? Well, we do it too. What did they set up out here for in the the common area for each of us? Bloomberg terminals. Why? Is the underlying value of the assets in which we're invested going to change that much today? No, the market's going to go up or down, but we're all kind of focused on that stuff as well. So we're all guilty of ADD bias. And then herd mentality. You can read what's on the page, but let me just say I'm a fisherman. And I run a little boat in Long Island in New York. Not this time of year, it's way too cold and too much snow. But in the summer I run a little boat. And I've been fishing for 10 years in the same body of water, so I have a pretty good idea of where the fish are going to be. I've marked a lot of spots in my GPS, I've been out there a lot, I've gotten lucky in spots, and lucky in a spot or going to a spot you know, if you catch fish, it's a good spot to go. And so I come out of the marina, out of the channel, into the harbor, and the sound opens up in front of me, and I know that I'm going to mark 22 on my GPS, because that's what I feel good about today. But as I'm coming out of the harbor, there's a whole bunch of boats over here. Why are those boats over there? Well, because they're catching fish, right? I don't know that. The reason they're over there is because the first guy out of the harbor that morning went to that spot. The second guy that came out of the harbor did what I did. He was going this way, and he was like, oh, wait a second, he must be catching fish over there. And so everybody will continue to follow the first person in the absence, and it's easy to say in the absence of better information, but even in the face of better information. Why? Because it's easier to be unconventionally wrong than take a risk of being wrong when you're standing out by yourself. So if I went out and I didn't catch any fish in my spot, I'd be looking at that fleet all day long going, oh, what an idiot. Those guys have been catching fish all day. I'm hard-headed, I was here. If I go with them and I don't catch fish, everybody was wrong. There was no fish around today. It was not my fault. It's everybody's fault. So it's easier. Similarly, I'm here with a couple of colleagues, and if they weren't available for dinner last night, and if they hadn't taken me to the dinner last night, I would have been left on my own. How would I have chosen a restaurant? I would have gone down to the concierge and said, where should I go? And she would have said, well, you go over to Main Street, and there's a bunch of good little places. And I would have gone down to Main Street and walked up to the first restaurant and looked at the menu on the door and said, looks pretty good. Prices are right. Looked through the window, but there's nobody in there. But she told me it was a good restaurant, but there's nobody in there. So I go to the next place, and I look at it, and it's virtually the same menu, virtually the same prices. I look through the window, and it's full of people. Guess what? That's where I go. It's human nature. We tend to follow the same things. So the challenge is, how do you be an individual? Now, in 1999, most of us in this room that were in the business in 1999 probably knew that the stock market was trouble waiting to happen. But what happened? Client comes walking into the office, says, I want to buy Global Crossing. And you said, all right, let me get my order pad, and you got ready to take an order. Why? Well, because you knew in your head that the right thing to probably do was say, you might want to take a pause. You might want to consider another segment of the market that's not so overvalued, or God forbid, bonds. But had you had that conversation, what would that client have done? They would have walked out your door, in the door next door, and say, I want to buy Global Crossing, and the guy would have written the ticket. So in this environment, with the 10-year at 260, it's a hard conversation to have, to say, stocks don't look super expensive. Relative to bonds, they actually still look cheap. Yes, they entail short-term risk, but it's hard to derail clients who, left to their own devices, will do the bad things. Why do we make the decision to put them into stocks? It's because there's safety in numbers. If everybody else is doing it and you get it wrong, how bad are you going to look because everybody got it wrong? Whereas if you tell them to go somewhere, and maybe even only near term it doesn't work, you look like the goat and you lose the client. So it's that notion of herd mentality. Tips to combat the influence of emotion. Know what your investment philosophy is and stick with it. From our perspective, how do we do that? How do we have a philosophy and stick with it? A very important part of our process, not the entire process, but probably 2/3 of our process, is quantitatively driven. What are the shortcomings of quant models? Shortcomings are they can't tell you a lot beyond what the data tells you. Shortcoming is if you put garbage in, you get garbage out. What are the strengths of quant models? Discipline. They don't know any different. You tell them to do something, they'll do it over and over and over and over and over again. The ability to have a systematically deployed opinion on a big universe of securities. So systematically deployed opinion on a big universe of securities and rules-based investing. But how do you offset the shortcomings? Well, you marry with it, at least we do, a fundamental overlay, which is probably 1/3 of our process, where guys are actively looking at the data, not the alpha score. It's not the model likes Macy's, I hate it, so I'm not going to buy it. It's the model likes Macy's, why does the model like Macy's? What are all the underlying inputs? improve any of those? Is there something that's not reflected in it? And I'm not talking about now making my own judgment of what this company is going to do, but let's say that, that a biotech company buys another company, and you know that it's going to go through, but they've been, it's not going to close for 12 months. My forward valuation signal is 12 months out, so I can't possibly recognize the accretive benefit of that acquisition because my model's not looking far enough out to recognize it. So what do? Well, you know that that's coming. You know it's beyond the scope of your model, so you take that future known cash flow, discount it back into the present so that the model can more accurately analyze it. So it's not about trying to outsmart the model. It's trying to improve the quality of the inputs. Write down your rules. It's real easy to change your mind if something's not staring you in the face. But if you write down your rules and you have them taped to the side of your monitor, up on your wall, whatever it may be, every time you're tempted to change something, you look at it and go, I'm overriding one of the things I believe in. Do I really want to do that? So it may not force you to change your mind, but it does force you to think about it. We talked before, actively seek out contrary opinions. It doesn't feel good, but it's the right thing to do. It helps you to build a more robust thesis whether it changes your mind or not. And then understand that, look, we all make mistakes. But we have to admit it, have to own them, have to learn from them, and move on. Only by learning from our mistakes can we make better decisions in the future. Now, rather than reading to you the quote from Uncle Warren at the bottom of the page, you can all read it. Can anybody point out the flaw in that quote? And it's not a typo, so there's a flaw in that quote. Anybody see what it is? Well, so it is the IQ number, and it's the investing is not a game where a guy with the 160 beats the guy with the 130. Once you have ordinary intelligence, who thinks 130 is ordinary? That's freaking brilliant. So, but it's true though. Investing's not a game where the smartest guy wins. Investing's a game where the guy with the greatest intestinal fortitude wins. The ability to look at the market when it's cheap and say, it's cheap because it feels bad, but frequently the things that are the best decisions long-term feel the worst when you make them. Similarly, the investment decisions that are the worst frequently feel the best when you make them. So, a number of the factors that we look at, things like valuation, you can see a very real relationship between undervalued and overvalued securities. Poking fun at Amazon last night. Amazon's an expensive stock. So it's not every expensive stock that underperforms every cheap stock, but if you add it all up and analyze it over time, on balance, cheap stocks outperform more expensive stocks. What's the theory? Well, it's overconfidence, over pessimism. Stocks get cheap, and it's maybe it's hard to buy them because, well, it's cheap. It must be cheap for a reason. Maybe something's broken. And when in reality, maybe it's cheap because other people don't recognize the opportunity yet. And similarly, when things get expensive, it's easy to buy an expensive stock because that valuation is testament to the fact that this is a great company. If it wasn't a great company, it wouldn't be trading at 300 times earnings. But over time, while that's the easy thing to do, we know that undervalued stocks outperform overvalued stocks. Momentum. Funny, but stocks that go up outperform stocks that go down. No, that's not actually what it says. But what it's showing is that stocks that have improving momentum, so building momentum, tend to outperform companies that have deteriorating momentum. And we talked before about Apple. So when managers are using price momentum in a screen to identify stocks that may work, they're looking to identify a company like Apple that's showing evidence in the stock price that something's going on that maybe they can't get their heads around yet. Quality. For us, there's really two types of quality. There's quality of earnings, which we show here. And you can see that companies with high quality earnings do outperform companies with low quality earnings, though it's not as linear a relationship as the others. For quality, we look at things like accruals. So we look at reported earnings versus cash earnings. Why? Well, because management teams are incented to maximize reported earnings. And we know that incentives drive behavior. So if a management team is being paid to maximize reported earnings, what are they going to do? Maximize reported earnings. And yet we know that over time, reported earnings and cash earnings should be the same. So we look at the differential between the two. And to the extent that cash earnings are going like this and reported earnings are going like that, we know that at some point there will be a correction. And when there's a correction, cash earnings never get adjusted to reported earnings. It's the other way around. So if you get a big positive accrual, it represents a risk. Whereas if for whatever reason reported earnings start to fall below what you know long-term cash earnings look like, it represents an opportunity. The other interesting thing about management teams is that CEOs, big egos, tend to be very overconfident, as we point out here, but they tend to be acquisitive. And yet there's been a lot of work done on a study called the Winner's Curse. The Winner's Curse is a study that believes that in a competitive bidding environment, the winning bidder always overpays. So we need one of these, right? And we're all bidding on it. Everybody in this room is bidding on it. One of us is going to win that bid. Why did we win that bid? We won that bid because we were the only ones able to justify the price paid. So we have theoretically overpaid for that asset. Well, the same is true in M&A. Nobody says that company A has to be the acquirer of company Z. It's theoretically a competitive landscape, and anybody can bid for that company. But the winning bidder tends to overpay. So we do prefer companies that aren't serial acquirers. We prefer companies, when we look at then how are they deploying capital, we prefer companies that if they do acquisition, are funding it through cash as opposed to either issuing stock and diluting the balance sheet or diluting the business, or debt and leveraging the business. We look at the money they spend. How are they spending it? Are they spending it on capital improvements, or are they spending it on R&D? Because to us, we're looking for a company that can grow earnings over time. Well, is investing in the plant going to help you grow earnings over time? Probably not the same magnitude that investing in R&D will. So we prefer companies that are making what we believe is a more constructive use of capital. Although on balance, we prefer companies that are conservative stewards of capital. And that's really it. I mean, there's a lot more that we could talk about, but we've kind of gone through what does it look like, why do we do what we do, and identified some of the things that we have to do to offset the urge to do those things over and over again. So with that having been said, and approximately 4 minutes until my timer's going to go off, anybody have any questions for me? Yes?
A couple questions. I guess one easy one. It seems like indexing is the ultimate herding.
Absolutely.
If you'd agree with that or not. And then I guess my second question, I guess the next level in this behavioral finance is that a lot of this stuff is actually hardwired to individuals. It's like our height, our weight, our personality. And isn't it just like, if I can't run the 40,
keep trying.
I should not even be trying to invest, period, just based on my sort of personal makeup.
So 2 kind of statements or questions. One is that indexing is the ultimate herding, and it kind of really is, because why are people doing it? Well, because if you invest like the benchmark, you can never underperform the benchmark. Although when you take into account frictional costs, you probably do underperform a little bit, but at least you know how you're going to outperform. And there's a good reason for it. That good reason is that a study done by Brinson years ago shows that if you take 2 series of returns, 2 pension series of returns, and look at the difference in those returns, 91.5% of the difference in those 2 series can be attributed to asset allocation. So sub 10% is determined by the managers that you're picking in those buckets. So there's some plans that don't have the internal staff, that don't have the budget for a consultant, and for them, it absolutely makes sense to do that, because the vast majority of your return is going to come from getting the asset allocation right. But for us, that other 10% is not 10% we want to leave on the table. And if we can identify a manager with consistent or persistent good returns, we want to try and make a little something off that. And the other statement or question was, a lot of this is hardwired to each of us. So if we know that we're hardwired to do something, why would we try to do otherwise? And that's why rules-based investing, that's what we do, we think makes so much sense. Because there are a lot of times when the model's telling us to do something, and maybe it doesn't feel right. But we look at all the underlying data, and there's nothing we have to disprove it, and we have very strong evidence that what we do works over time. So despite the fact that we have an emotional reaction to maybe not do it, we'll do it. In January of 2009, a client that I had had for about 10 years, it was a balanced mandate. Each of their 10 managers, as opposed to giving us each an explicit asset class to manage, they had given each of the 10 managers the same mandate, an 8% absolute return. Build it yourself, and we'll put it all together and we'll be diversified. But of course, if your goal is 8% return, and you give 10 people the same mandate, you're not going to be diversified. Everybody's going to own equities, because that's the only way you get the 8% return. So what happens? 2008 comes, and they thought they had a diversified portfolio, and they got their butts handed to them. So January of 2009, I get a call. Actually, February of 2009. We can't take it anymore. We got to sell all of our equities. We were 10% of their money. We were $650 million. So multiply that by 10. That's real money. we need to sell all equities. We can't take it anymore. And that was an email I had when I came in the morning. Instead of responding by email and saying, okay, I picked up the phone and had probably the single most contentious call I ever had with a client. And that conversation went along the lines of, you're absolutely stupid. You cannot sell here, because if you do, then everything that you've lost, you lock in, and there's no potential to make it back. And I was able to look at it that way because it wasn't my money. They weren't able to look at it that way because it was their money, and they knew that it had to be there for the future. I was able to remove emotion. They weren't. Guess what they did? End of February, all equities were blown out of. What happened at the beginning of March? Market went back up, and they never realized it. So some of us are hardwired. That's why we work with advisors. That's why we write down our rules. That's why we approach investing from a rules-based perspective, because it's hard to overcome, because a lot of it is hardwiring. Yes?
Any behavioral techniques to identify turning points?
No, and in fact, turning points is where a lot of quantitative managers fall short. If you're using momentum in a model and the market's going really well, what's the market telling you to invest, or what's the model telling you to invest in? Really aggressive stuff. And when you have a big inflection point, now you're invested really aggressive and the market turns around, you should be really defensive. So there's no specific tool. But what we do, and we do use momentum in some of our models, is we run some sidecar models. And those sidecars are designed to identify, is that likely to work well in this environment or not? So is momentum likely to work well in this environment? It doesn't time things perfectly, but it told us in May of 2009 that we're going to get our hats handed to us if we kept investing, and, if we kept being as defensive as we were. So we actually turned off price momentum in May of 2009. Now, we lost probably 600 basis points of returns between March and May, but we made back about 400 of that between May and the end of the year because we were able to turn off price momentum and get aggressive in a rising market. Same thing happened in 2011. August of 2011, the market goes like this. And we didn't turn it off right at the bottom, but we were able to turn off price momentum in early September because there was an indication that we were getting a bad signal from that. And we didn't save the same magnitude, but we actually made our clients about 75 basis points in that environment. There's no silver bullet. And you can't rely on a model to tell you, because the model doesn't know a whole lot. The model's just saying, well, based on the vol regime, value spreads, correlations, velocity, this is how historically that signal would have done. But once the model tells you that, then you sit down amongst yourselves. You have your quants sit down with your fundamental guys. You have everybody sit down with the CIO. The whole team gets together and says, this is what the model's telling us to do, right thing or wrong thing. So there's no magic bullet. There's no silver bullet. But it is possible to do if there's discipline embedded in your process. I saw a question up here.
Talk about learning from your mistakes and how you make sure you learn the right lessons from your mistakes.
Sure. By the way, this guy in the front has been taking more notes than anybody, so if anybody wasn't paying attention throughout it, he'll be selling his notes at the end of the presentation. So how do you learn from your mistakes? How do you identify your mistakes? The right lessons, right. Well, when something doesn't work, was there a way that I could have known? So if I'm buying a top and the market ultimately rolls over, and I had an inkling that maybe it was getting expensive, but somebody last night made a comment about it. It's easier, the worst feeling in the world is to be short something that works. You have to identify those events and the times you did it and say, what did I do wrong? And it's too easy to say, nah, it was a mistake. And in the context of the overall portfolio, it doesn't make that big of a difference. But what you really have to do is be kind of laser focused on the things that you do wrong. The things that you do right, theoretically, are easy to do. The things that you do wrong are theoretically easy to do, but you need to identify what you did and then figure out how you'd remediate it in the future. And all you can do is be disciplined about it. Identify them, own them, write them down, understand what you did, cover them with yourselves, with your colleagues, with your clients, but talk about them. The easiest thing to do is to hide them away back here somewhere in the back of our head and hope that enough other good memories surround them that we don't have to think about it anymore. But the right thing to do is actually stop and to focus on it and identify what went wrong and why was it. Was it something I did that I could have known, or was it something that I couldn't have known? And if it's something you could have known, you analyze the event, write it down, and move on. I don't know if I have time for any more questions. Oh, I'm not answering questions from you because you were tough last night.
Well, thank you.
You're welcome. Go ahead.
Okay.
Nobody's giving me the hook, so one more question, and it's yours.
Philosophize or find the experts philosophize. Can we do anything to overcome the population of the United States to where communism and socialism are taking over understanding our economic system. I think it's totally appalling, but given what you said, maybe we can never fix that. I mean, do any of your experts ever talk about that? Or have you reached some conclusions about that? That's the question.
I think it was Jim Grant last night that said, can we talk about religion now? It was. So no, you know what? Look, I am not a financial advisor. I'm not a registered investment advisor. I'm not sitting on a pension board. I'm on the other side of the game, right? I'm part of an active management equity team. We manage client portfolios for clients of all sizes. Despite that, though, my father, who's a scientist, my mother, who's a piano teacher, my sister, who's an architect, come to me for financial advice. And it's not that they're stupid, it's that they're ignorant. It's not what they do. I mean, come and ask me about, what size I-beam you need to support a span of 40 feet. I don't know. My sister could tell you. I don't know, A minor chord. My mom could tell you. I can't tell you. And so they come to me for financial advice. And it's just because they don't know. And that's what we're dealing with. I can't tell you how many times I've talked to my father, and he has an advisor that he works with, and he hears from the advisor, and then he comes to me and says, what do you think? Like, how do I win here? That guy's getting paid regardless of what goes on. I'm going to be wrong forever if I override him. And so I continually give kind of the same guidance. And it's hard to do, but I think it's the right thing to do, which is that when you sit down with somebody, say, look, we're planning for this time period, and that's your goal. This is what you need to accomplish in that time period. My advice to you is to build a portfolio that looks like this, and then don't look at it for a year. Because invariably, in January of 2014, you're going to want to sell emerging markets. But we talked about the fact that buying things when they're broken seems like is probably the right thing to do. So there is that part of the population that just has no idea at all what's going on. They're going to follow asset prices, buying winners and selling losers. And we understand that. And that's one of the reasons that this study works, right? Because we can identify weaknesses in management or likely behavior of management, but we also know that half the population has no idea, and that's why we look to analyze the behavior of the market. We look at things like valuation, because to my point before, a lot of people see a cheap valuation and the stock must be broken. Chances are pretty good, based on that slide I showed you before, it represents an opportunity.
Can I come back with a...
You can come back.
Is there any time? The whole business, and by that... I'm educating our clients, and people own stocks directly, kind of like Warren Buffett. They understood or tried to understand how things work. Well, the whole thing is gone kaput. It's all give your money to someone, advisor class, whether it's a mutual fund or packaged products or whatever, and don't worry about how it works. And I think that's bad for the economy in the sense that people don't know.
I think
don't
that
expect to know. That's a theory.
I think that the best thing we can do is to educate our clients. So we should absolutely sit down and tell them, this is why we've done it the way we've done it. This is how the different things work historically. This is the role they play in, the different roles they play in the capital structure. And we've built a portfolio that looks like this because your goal is the following. And this, based on everything that we know, and we can only operate based on what we know, is the right way to get to your goal. But then the other thing that we have to do is say, don't worry about it. Don't worry about it this month, next quarter, for the remainder of this year, because we're not investing for this year, we're investing for year 20. So it's a combination of education and setting appropriate time horizons. I apologize, I've now been given the big black and blue sign that says time, so I have no more time, but thank you all for yours.